right, we've been having a great day, and I want to introduce our second panel of the day on macro-prudential regulation. It's an issue that we've danced around for most of the day, and our question is, most folks think that, I should say a lot of folks are pretty confident that markets as regulators work pretty well when we're talking about the firm level. If your business simply doesn't produce value for people, you tend to go out of business. But there's much more wide variance in opinions when we get to the system level. Do we need one office to look out for the integrity of the system? Or can markets act as regulators for the system as well? And we want to explore that question in this next panel. We're very fortunate to have Mark Calabria from the Cato Institute join us as our moderator for this panel. And again, remember, Mark is the host for day 2 of After Dodd-Frank tomorrow at the Cato Institute, and we'll share some details, more details about that in our concluding remarks today. Please help me welcome Mark Calabria.
Thank you, Dino. I think this is a terrific panel to follow on the previous regulatory panel because the regulators spend a lot of time talking about, the sort of, to me, within the yard line little pieces. And this is going to be a much broader, not just on macro prudential regulation, but on macro issues in general. You might notice we were not doing a bait and switch. Hal Scott, who was supposed to be on the panel, was going to come in last night from Cambridge, and thunderstorms threw off his trip. So apologizes for not being here. I'm certain he's watching this streaming right now. So, but that said, we were very fortunate that Norbert Michel from the Heritage Institute, who is the research fellow in financial regulation there, could join us instead. And Norbert's right there. On my far left, maybe your far right, Larry White, who's a professor of economics at George Mason and a senior scholar at the Mercatus Center. I'll note he's also an adjunct research fellow at the Cato Institute as well, and also associated with the Mercatus Center's financial regulation working group. And then immediately to my left, Tom Hogan, who's an assistant professor of finance at the Johnson Center for Political Economy at Troy University in lovely Alabama. And I always have to be nice to that, being a former Shelby staffer. Appreciate what people are doing down there. And Tom is also a former summer fellow at the Cato Institute, so we've gotten some consistency there. We're going to try to take a step back and look at some of the broader issues, and I see this panel as defined by kind of two separate issues, two separate related issues, that is. One is the issue of market regulation versus public regulation, government regulation. And I will emphasize, to me, I don't see this as the sort of familiar straw man of self-regulation, but regulation of market participants by each other. And the second part of this is the difference between micro-level regulation of individual institutions, which has really characterized financial regulation for a very long time, versus what's often called macro or sometimes meta-regulation, where you're trying to look at the stability of the system as a whole. And so that I'm going to do something that we don't really do often in Washington, which is try to start spelling out the basic assumptions of what we're trying to do. We're oddly enough a panel of 4 PhDs. I spent my time on the Hill where the questions are rarely debated. It's we've got to do something and here's something, so let's do it. And so what I want to start out the conversation with is having each of the panelists take a stab at what exactly is macro-prudential regulation? What is the problem it purports to solve? What is the problem we should be solving? And then we'll come back after that and start talking a little bit about whether our current structure of regulation actually has anything to do with those problems. So let me start with Tom.
Well, thanks, Mark, and thanks, everyone, for coming today. Let me start by saying that I do a lot of research on banking and bank holding companies, and so I'll talk a little bit about individual bank risk, but then also how we can regulate risk in the entire banking system. And so if I say the Fed instead of the regulator, it's because I'm used to just thinking about bank holding companies, but you can substitute that for one of the many regulators that we've been talking about here. And so if we're thinking about the problem of bank risk in general, or meta risk for the entire banking system, we might think that having the government regulate that risk is really the best way to go. I mean, certainly that's the first thought that everyone has is, well, the government needs to do something. We need to get out and regulate that. But that doesn't seem to have worked lately or in U.S. history. I mean, despite the cries that the recent financial crisis was because of deregulation, research by the Mercatus Center seems to indicate that bank regulations increased throughout the 90s and throughout the 2000s leading up to the financial crisis, and of course thereafter with Dodd-Frank. And so it doesn't seem like government regulation did a very good job of limiting systemic risk in the banking system. So we want to talk a little bit on this panel about market-based regulation as an alternative to that regulation. But what do we mean by market-based regulation? I think a lot of economists, when they say market-based regulation, what they mean is that the regulator is going to have some kind of market indicator that they're going to use to regulate. That when we look at banks, we should look at the volatility of their stock returns as a measure of risk, or that we should force them to issue subordinated debt and look at the yield on that as an indicator of risk. Or like somebody mentioned in the previous panel, that we should have all the prices of all the assets and comb through those to look for systemic risk. The idea is the regulator can look at market prices and use that as a guide for their policy. That's not what I mean by market-based regulation. When I think of market regulation, I'm talking about the market participants themselves actually doing the regulation. So I think of, in terms of banks, the depositors regulating the bank, the equity holders regulating the bank. Of course, we don't have that today because those groups are protected, right? Deposit holders are protected by deposit insurance. They don't have to worry about getting their money. If the bank fails, they still get paid, right? Equity holders bear some risk, but they don't bear full risk because they have limited liability. And so there's only so much they can lose, plus the fact that we keep getting in and bailing them out whenever there's a problem. And so today, we don't really have depositors or equity investors bearing a lot of risk, and so they don't need to regulate the banking system. But that wasn't always true in the United States. If we look back before the FDIC and before the Federal Reserve, we saw that we did have depositors that were effective at regulating banks. Right? If I'm a depositor and we don't have deposit insurance, I have to worry, do I want to put my money into this bank? If the bank fails, am I going to get my money back? Well, because they worried about that issue, banks had to prove themselves and show the depositors that they were safe. A lot of times they would publish information about the assets that they held so that they could point to that and say, look, we're buying safe assets. You can trust us. You can give us your money. And they were transparent in that way, in a way that we're attempting to do through Dodd-Frank and government regulation today, but it doesn't always work. We see the same thing in history on the equity side, that before equity investors were protected against the losses in terms of limited liability, they were more likely to regulate the bank. So before the FDIC started in 1933, in the United States, equity investors in banks had double or even triple liability that they could lose if the bank failed, right? So if I buy a stock in a bank, I'm not just on the hook for any losses that I take if the stock goes to zero, but rather if the bank fails, the depositors and the liability holders of that bank can come after me personally, can sue me personally to take my money in order to repay those debts. Right? Obviously, that gives the bank managers a much greater incentive to not invest in risky assets because their equity investors are really on the hook. In fact, in Europe, it was even stronger. If we look back to England and Scotland in the days when limited liability was just becoming a popular form of corporate governance, we see that a lot of banks at that time refused to become limited liability because they wanted to be able to tell their customers, they wanted to say, we are unlimited in liability. If our bank fails, you can sue me personally for everything that I'm worth.
So
that gives a pretty strong incentive.
So I can summarize that a little bit. What you're arguing is that maybe the problem we're trying to solve or what we're trying to fix is having to increase, basically monitoring of institutions, and that the argument that you're putting forward is that, whether it's deposit insurance or too big to fail or any of these other type guarantees, has reduced the monitoring by private market participants, even if we've increased the monitoring or hope to have increased the monitoring by regulators. Would that be a fair summary?
Yeah, rather than having the regulators do all the regulation, I think real market regulation is when the market is doing the regulating, when the depositors are regulating the bank and making sure it's not taking too much risk, when the equity holders are regulating the bank and making sure it doesn't take too much risk.
I'm going to jump over you, Norbert, and come back to you after I go to Larry.
He wasn't ready for that.
I was just making sure he's awake over there.
When people talk about macro prudential regulation,
The main problem they have in mind is the impact of leveraging on the market as a whole, or sometimes described as trying to prevent bubbles from forming. I think John Cochran emphasized something very important this morning, which was the real problem is not run-ups in asset prices. The real problem is when they come down. The real problem is crashes and panics. So if we could fix the problem of crashes and panics, then we would have accomplished really all that needs to be accomplished. I differ a little from what he said, though, in that I think markets actually do a pretty good job of reducing the run proneness and the fragility of banks when they're not prevented by legal restrictions. And of course, in the U.S., we have had a very fragile banking system through our history because we restricted banks. Under the National Banking Act, we restricted banks' ability to convert deposit liabilities into currency liabilities. There was a limit on how much currency banks could issue, and they were the source of currency in those days. And secondly, we've always had these restrictions on branch banking. Banks were chartered by state governments. Other state governments didn't recognize those charters. So at most, a bank could branch within state lines. In many states, it was one bank, one office. They had unit banking. So banks are very poorly diversified. Therefore, they couldn't convince customers that they were safe, and they weren't safe. They did fail in droves because they were poorly diversified. So I see macroprudential regulation as trying to fix a problem that, as you said a minute ago, we've created by weakening our banking system. If you look outside the US, if you look at Canada in the 19th century and early 20th century, if you look at Scotland, which Tom mentioned, and a dozen other countries that had the most minimal bank regulation, you see they were actually stronger banking systems than the US system, or more generally than countries that heavily regulated their banks. And so run proneness is not an inherent problem. We sort of have created this problem and then tried to fix it with a new set of restrictions. But those restrictions creating their own problems.
Before I go to Norbert, you've raised a point which, to me, one of the fascinating parts of the conversation is, before the financial crisis, certainly my read of the academic literature was this, fragility came from having, a very fragmented banking system. It wasn't even until the 1990s in, say, Texas, you could even have a second location.
Right.
And obviously, if the one employer in town went down, the bank was going to go down. And despite the fact that I guess a little more than 500 small banks did fail this time around, we'll set aside that we treat them a little differently. We let them fail. The conversation in Washington has certainly taken, to me, a 180-degree twist from where the academic literature was pre-crisis, which is the conversation in Washington is the problem is these big mega banks. And that's where the risk in the system is. And despite the knockoff effects in the 1920s or the knockoff effects from the savings and loan crisis, there's kind of an assumption that if hundreds of small banks go down, that's not too good for them, but whatever. That's not going to be systemic in the same way that if Citi got in trouble. So let me ask you, Larry, has that 180-degree shift in conversation just gotten it wrong, or is there something else there that the literature missed before the crisis?
Well, I think the problem today is with the large banks. I mean, that's what we have to be worried about. We've sort of artificially changed the environment such that the share of deposits held in the 5 largest banks is a lot larger than it used to be. And so we have to worry about those institutions. And we're regulating them all in such a way that basically they're supposed to follow the same kinds of guidelines. And so we don't have a diversity of strategies really being pursued. So if one of them is in trouble, then you're pretty likely that another one is in trouble, just as in the old days, if a small community bank was in trouble, the bank across the street was probably in trouble. So I think we sort of swung too much. We've created a lot of these huge banks by arranging shotgun weddings during the financial crisis, of course.
Well, you also touched on a point. I want to come to Norbert, but I also want to come back to this point, which is because it made me think about one of the questions that was asked of Chair Yellen this morning was about the stress tests. And you've seen such a push, whether it's the Basel Capital Accords or whether it's stress tests, for approach of prudential regulation that says kind of everybody needs to look the same. We're going to have a one-size-fits-all. And I want to come back to this issue of the encouraging of homogeneity in the system itself causing systemic problems, because when everybody's a seller, there aren't a lot of buyers, which could exacerbate fire sales. But with that, I really want to kind of roll it back to the beginning and give Norbert an opportunity to say, what exactly are we trying to fix here?
Thank you. Well, that's an interesting question, and this is the part that I've been most fascinated with, is when you try to figure out what are we talking about when we say macroprudential regulation. You really find that the definition just keeps changing. And in a very real sense, this isn't anything new. This is just sort of tweaks of what we've already had. In general, we're talking about some way of protecting a crash in one or two institutions from being propagated to the larger economy. Well, that's why the Federal Reserve was ostensibly created in 1913. So, I mean, let's sort of be real about what we're talking about here in that sense. And then if you just go through time, the Basel Accords that were first signed by the U.S. or agreed to by the U.S. in the late 1980s, all of those are based on what was called the risk bucket approach, which is what the Federal Reserve was using in the 1950s when it was already the regulator, the main prudential regulator of bank holding companies. Fast forward just a little bit more, you can go and look through congressional records in the 1990s. There was a House subcommittee on financial stabilization. 1996, the Federal Reserve formally adopted the CAMELS, C-A-M-E-L-S system. Prior to that, it was the CAMEL system. S is bank sensitivity to market risk. So, I mean, the notion that all of a sudden now our federal regulatory apparatus is going to pay attention to systemic risk or macro risk is misleading at best. And if you look at exactly in practice how this is being done, effectively what you have is simply a slightly higher capital requirement. You're talking about a the only two things that are really different in the new round that we have are the countercyclical capital requirement and the stress test, which of course only apply to some banks. But the fix, if any of those things look bad, is to increase capital. That's all we're doing. So,
and of course we are. The other component of this is, I mean, we spend a lot of time talking about banks, but certainly a lot of Dodd-Frank is about sort of macro regulation of non-banks. Spreading the safety net behind everybody.
We are, and that part is different in that we're spreading. Yeah, no, I don't mean that way. But if we focus on just the bank part and just the idea of a macro regulator, then this isn't entirely new. But
I've often characterized Dodd-Frank as the theory that if we just regulate the rest of the financial system as well as we had regulated Citibank, everything would be okay. That said, I want to touch on what I always find, kind of one of the more frustrating issues in the conversation about banks, to get back to that, which is this notion that, we just can't let banks fail. Set aside that apparently we can't let auto companies fail either. But by and large, in a capitalist society, we think it's a good thing that people try things, people fail. The assets are redistributed to people who are successful. We have a very friendly bankruptcy code in the United States compared to the rest of the world. We accept and we, in some sense, allow, if not on occasion, celebrate failure in the U.S. You should be able to give it a try. You should be able to give it a try again. Yet in banking, there really is this notion of the last thing we can allow is to have an institution fail, unless, of course, you're small, and then we let you fail. But that said, the sense of if we have to keep these institutions around. And so I want to ask, are we seeing this kind of trade-off? Maybe the way to think about it is frequency versus severity, so that if we try to have this, and maybe the analogy of have we just built one great big dam to hold back the water, but when it goes, it's going to go ugly? Are we in that system? Or would we be better off being a little more tolerant of failure? And let me kick it to Larry, but I'll come back to you two as well.
Definitely. And so we want to have a system in which we can allow even a large bank to fail without big spillover effects. When everybody expects to be rescued, then, as in the case of Lehman Brothers, when somebody isn't rescued, then suddenly people have to recalibrate all their expectations, and that causes havoc. But if we make it very clear that nobody gets rescued, then the failure to rescue somebody doesn't change anybody's expectations. That's what they should have expected all along. So, I mean, that's the key to sort of containing the information cascade. People trying to update their expectations based on whether this institution was allowed to fail or not.
So for the non-economists in the room, can you give me a layman's information cascade? I know what you mean, but let's say somebody else might not know what you mean.
Well, what I said, in other words, people are trying to recalibrate what are the odds of the institution I'm lending money to being allowed to fail in a way that makes me, the bondholder, take a loss.
Gotcha.
So if I lower that probability of getting rescued, then I don't want to lend to them anymore, and credit dries up.
I mean, is that what you see? Is that the primary spillover? Is the sort of informational, I need to think about if this bank is unsafe, then maybe other banks aren't unsafe? Are, there are other sort of narratives out there that if this bank fails, then its customers it has had lending relationships with, that soft information is gone, and lending is constricted. And so let me ask the question this way: you mentioned spillovers. What are those spillovers? How real are they?
If you look retrospectively at the resolution of Lehman Brothers, other firms lost money, but didn't bring anybody down. It was quite orderly.
So the extent to which, if the kind of domino theory, if we, it's not necessarily if this institution goes down, it doesn't mean that 10 other institutions are going to go down. That your read of the evidence is that's not really supported.
That's right.
Okay. Let me, turn it
No,
over.
I think if you look historically, I think you make exactly the same case. I think in the 70s, the Nixon administration, I could have my companies mixed up. It was either Penn Central or Franklin National. I think it was Penn Central. The Nixon administration went to the Fed and said, hey, let them go to the discount window, and it was over a commercial paper issue. The Fed refused, but after they refused, they went out and said to everybody in the commercial paper market, look, don't worry about anything. We'll take care of it. We'll ensure liquidity in the commercial paper market. As if Penn Central's failure would decimate the entire commercial paper market. Yeah. And there's, it's conjecture, it's speculation.
I mean, there's this interesting theme to me that in financial regulation, because what you were talking about in the commercial paper market got me thinking about the conversations I often have people in mortgage finance, where part of the argument is, you need to have a system in which investors don't care about credit risk. And so, when I hear people make that argument, granted, I'm always the sort of one person in the room who sort of, what do you mean we don't want investors to care about credit risk? But again, that's the argument for a federal guarantee of a Fannie, Freddie, and such. And you sort of see this very same approach to the commercial paper market. You see the very same approach to, regulation of mutual funds. And so this sense of we need to make investors feel comfortable by wrapping a government guarantee around everything. What are the long-term, is that the right approach? What are the costs and benefits of that approach? I'm going to let Tom take a stab at that, but open it up a little bit. Should we be giving, should we be guaranteeing everybody above Treasury rate returns with Treasury rate risk?
Okay, so so no, there are a couple of different things that I think are interesting about the topics we've been talking about here. So one of them is, first of all, we've removed the incentives that I talked about earlier as far as market participants wanting to regulate the banks. We said that that's not necessary. And not only have we said that's not necessary, we've taken it on ourselves as the government or the regulator to do all of that regulating on their behalf. We just said, risk, don't worry about it, we got this one, right? And so they're supposed to take care of all of it. But not only have they done it, not only has the Fed or the other regulators not done it in an effective way, I think like you've said earlier, they've made it a little bit worse by increasing systemic risk. And so the thing that I think about is like when you said they encourage people to all invest in the same product, right? So we have risk-based capital regulations. If you're not familiar with that, the Fed looks at the balance sheet of all the different banks and they rate their assets and they say these assets are risky and these assets are safe. And if you want to hold more risky assets, you have to have more equity. Makes sense. It sounds like a good idea. The problem is they're not good at deciding what's risky and what's not. So they told the banks, buy as many mortgage-backed securities as you want. Those things are as safe as cash. And so, of course, that's what the banks did, right? That did not turn out well.
So let me
in
be
the
devil's
financial
advocate
crisis.
a little bit, and I'll say this because I want to come back to the mortgage-backed security, which I put that into sort of also thinking Greece or Stockton, California, or any of these things are risk-free when they're treated as such. But to be devil's advocate a little bit, during the crisis, we had Ben Bernanke chairing the Fed, foremost scholar of the Great Depression. You couldn't have asked for probably somebody who was supposed to be a bigger expert. Then I'll say on the other hand, I remember, just before Wachovia was getting in trouble, and I got a call from one of my aunts in North Carolina, and God bless her, I know she didn't have more than 100,000 in deposits. I guess I didn't know that for sure, but would have been a lot better of a nephew if I thought she did. But all that said, so she called me worried, and I had to explain that you got deposit insurance here. At worst, it's going to be a little pain in the butt, but somebody else will buy it, and you won't notice the difference. And so, what's the argument for saying that my aunt, who was worried, even though her deposits were insured, is going to be an effective monitor of bank behavior than Ben Bernanke? So I'm going to throw that to you, Tom. Why shouldn't we trust economists?
Well, so I think that people can kind of cherry pick those examples of, well, this person wasn't worried until they suddenly saw it in the news and then it became a problem. But if we think about markets, we're not thinking about one individual that's on the end of the spectrum. We're thinking about the marginal individual that's monitoring that bank, right? And so we have to decide. I mean, there's a question about if we have something like deposit insurance. On one hand, it might, in theory, make things safer. It can prevent bank runs. On the other hand, it might, in theory, make banks more risky because it creates moral hazard. Banks don't get monitored. They take more risk and fail. When we look at the real world, it seems like the problem of moral hazard is a bigger problem. The World Bank has several studies that they've done about deposit insurance around the world. There are lots of different types and levels of deposit insurance, and they find that countries that have more deposit insurance have more financial crises and more bank failures. The same thing is true if we look at the United States. At different states before FDIC national deposit insurance, the different states had different levels of deposit insurance, and sure enough, the ones with more deposit insurance had more bank failures. And so you're right, it is a question of we wouldn't know for sure, at least theoretically, if that would be a problem or not. But looking at the real world, we see that deposit insurance appears to create more bank failures.
I can summarize that argument before I turn it to Larry, which is, A, it's less expertise than it is incentives that matter in this case. B, the empirical evidence suggests that expansions of deposit insurance or expansions of guarantees in general are associated with moral hazard, and that does seem to be the overwhelming case. So if I think I understand the argument there, but let me open it to Larry. He seemed to raise it, waving at me, or couldn't tell for sure.
Well, we do let people make their own decisions about where to invest in mutual funds, and we expect them to do a little bit of research. Doesn't take much. You open an issue of Money Magazine or something like. Is that still being published?
Maybe online. I don't know if there's print anymore.
And so, in the days before deposit insurance, people didn't, undertake laborious study of bank balance sheets, but they had some idea of which were the reputable banks and which were the riskier banks. And one thing they could rely on was there were a set of experts in assessing bank risk who would either approve of a bank or not approve of a bank, and that was the other banks themselves. So just in order to clear checks, banks had clearinghouse associations. And to be a member of the clearinghouse association, you had to have a certain minimum capital because the other banks didn't want you to stiff them when the end of the day came. And so you could rely on a bank that was a clearinghouse member having adequate capital, and that capital being audited, the bank being examined by the clearinghouse, which had every incentive to get it right. And so that was the safe place to park your money. And if you thought that that bank was too conservative and wasn't paying enough, you could take more risk and earn a higher return as long as that bank didn't fail. But you might want to spread your money around the riskier banks.
So I want to come back to, because Tom raised a point that I use all the time, which is, all you really need to know about, Basel capital standards, for instance, is that pre-crisis it treated, Fannie Mae and Greece as risk-free. And so clearly, and also, I believe the Reinhardt and Rogoff numbers for Greece are that they've spent about a third of the time since World War II in default. So it wasn't like a shocker that Greece was actually a bad bet. But I think the retort would be, well, that's the politicians. If you insulated the regulators from the political constraints of having to favor certain classes of debt, I don't think any of the regulators thought that Greece was risk-free. I don't even think the Greek politicians thought that Greece was risk-free. But let's say that you set up this system where, certainly, and I also remember as well from my time on the banking committee, is you talk to any typical person at the OCC or the Fed, and they all thought that Fannie and Freddie were massively leveraged and in trouble. But they also said that, well, what can we do about the politics of it? So why isn't the solution to have an independent regulatory function like everybody argues for an independent monetary, setting aside questions about that? So Norbert seems to be excited to
Yeah,
answer
no,
this, so
we
I'm
heard
gonna
this
jump right into this.
yesterday at AEI. Somebody brought up the policy of having a sentinel, an independent, completely independent, purely independent, yet toothless body or organization of regulators that would evaluate the other regulators. I just don't know how you could possibly separate the politics from the government-sanctioned regulators. Public choice tells us a lot about this, and these guys are in charge of writing these regulations and enforcing these regulations, and there's just no practical way to completely divorce them and have this sort of utopian.
So your argument would be it's always going to be political. We might as well just start with that premise.
I believe so, yes.
Okay, Tom, you have a different take or echo that?
Yeah, so actually I think there's a different answer from something that John Cochran said this morning when he said, look, mortgage-backed securities themselves are really not that risky. They're not that bad. The problem is when every bank in the banking system loads up on mortgage-backed securities, then when there's a problem with them, they all fail at once, right? That's what we're afraid of. That's what we're talking about on this panel is the danger of systemic risk. And our regulatory system was increasing systemic risk by encouraging banks to buy lots and lots of mortgage-backed securities. And like you said, the same thing happened in Europe. Greek debt was certainly more risky than most government-issued debt, but it wouldn't have been a problem if we hadn't encouraged all the banks to buy it. If a couple of banks had bought a lot of Greek debt, so what? Not a big problem. But instead, in Europe, their capital regulation system that was basically the same as ours encouraged people to buy lots and lots of Greek debt. And so that's why when there was a problem in Greece, it created a financial crisis in all of Europe rather than just affecting a couple of banks.
Well, given, as Norbert touched upon the politics, I say we at Cato, I myself, am a big fan of the rule of law. I think, all banks should kind of be under the same set of rules. How do you have a system that encourages a diversity of asset holdings across institutions, but doesn't have basically the regulators come in and saying, well, what you've got's fine, but what you've got's not right. And how do you do that in a way, because to me, I always say that the lesson of Lehman Brothers is if you want to bail out, you better stay on good terms with the Treasury Secretary. That's the wrong lesson for the marketplace to take away. And so what I'm trying to reconcile here, and I'll throw it to Norbert and come back to you, which is if there's always going to be some politics, doesn't uniformity protect and insulate from the political process of where that discretion would mean some institutions are treated differently than others? So I'll come right back to you, Tom, but is that a concern, Norbert?
Well, I think so. I think I'll try to answer your question the best way. What I'm trying to say is that if you and I don't think it's inconsistent with what Tom is saying. If you look at why we had this, why did everybody have mortgage-backed securities? Well, everybody knew.
Ownership is great and good.
What's that?
Home ownership is great and good.
Everybody needs a home. But everybody knew with sort of a wink and a nudge, right, that the federal government would step in if there was a catastrophic failure and pick up the tab, and those cash flows on mortgage-backed securities would be guaranteed. So, of course, they're rated low or rated highly, right? So now that's politics, though. So, if you can depend ultimately on the politicians to set up a framework that forces the owners and the investors to bear the risk, great. I think that's what we should be doing. But that you have to be vigilant with that. That's at whatever point in time you actually accomplish that, it's not going to stay that way forever, and there's always going to be political pressure to shift some of those risks onto somebody else. So it's a constant. I think it's a constant battle, and the guys on Capitol Hill are never going to be completely out of that.
Tom, I don't know if you wanted to add or butter. No obligations.
Yeah, I disagree with the notion that consistency among banks would make that situation better. It seems to me that it's the opposite, because in the recent crisis, banks could say, look, we're all the same, and if I fail, everyone else is going with me. And if they weren't all the same, then the argument would be, well, no, you're not such a big deal, and if you fail, it's not a problem.
Well, I guess the question was more that I had was that trade-off between how do you minimize the discretion of picking politically favored. And again, number of empirical studies that look at this, and banks that have closer relationships to the government and power have a higher chance of being bailed out. It's certainly empirical finding that actually is common sense too. I don't think it surprises anybody. But it's harder to do that in a discretionary world. It's interesting that we tried, I think, after the S&L crisis, we came up with this thing called prompt corrective authority. We're not going to let you forbear forever. And so that seems to have not worked. So let me let you guys answer really quick, and then I'll go to some audience questions that might generate a little more controversy. But Larry, do you immediately?
Yeah, it's remarkable. The FDIC Improvement Act just completely went into the memory hole. It was supposed to have early corrective action,
And none of
and
that.
yet institutions that became close to insolvent on a book value basis, like Citibank and Bank of America, I think I'm legally allowed to mention their names. Instead, we now know, had special credit lines at the New York Fed. We found this out because Bloomberg got a Freedom of Information Act request. These lines weren't used, but they were there to keep them afloat if it was going to be necessary. But that's another case of forbearance of banks that were critically undercapitalized.
Well, let me see if there are some comments and questions. And let me emphasize, we have 2 microphones around the room. So if I don't see you at the microphone, then I just don't see you. So if you want to be called upon, stand at one of the microphones. And we'll go right over here first. And if you could identify yourself.
Jim Vitarello with GAO. I'm a housing specialist there.
Thank you.
Been looking at this latest crisis and the S&L crisis actually before that for a long, long time, longer than I like to remember. But I'd like to talk about something you guys have really not talked about, which I think is very much part of this as well. Someone mentioned it earlier in the early panel. It's the role of the shadow banking mortgage market, particularly the independent so-called mortgage banks like New Century, but also Countrywide, which theoretically was regulated, but in reality, their mortgage banking subsidiary, and we did a report on this, so I know it quite well, was virtually not regulated by the Fed at all on consumer protection. The Fed literally told us that Graham Leach Bliley prohibited them from examining companies like Countrywide's mortgage subsidiary on a quote-unquote routine basis. And that was true for virtually all of them, right? Long Beach, WAMU, same thing. Could you please comment on the role those institutions had in creating this crisis, recognizing that they virtually were unregulated by the federal government, and the role that the state governments did or did not play in trying to avoid that?
I think that's a great question, because I do think that one of the narratives behind Dodd-Frank is this, if we just regulate everybody else as well as the banks and the non-banks. So I don't know if any of you guys want to, Larry or Larry.
Well, I was going to say that those institutions that you mentioned that were originating a lot of bad mortgages, they were arbitraging an opportunity that was handed out by Fannie Mae and Freddie Mac, which was they would buy the mortgages.
They're the largest, the single largest purchaser of the private label.
Not in the early days, absolutely wrong.
Well, the early days, not recently.
In the case of the bubble, they were not selling the Fannie and Freddie.
In the 2000s?
Until about 2006, when Countrywide began to start selling.
Yeah.
I think some of it's the conversation about the direct purchases.
Fannie Mae, and when Fannie Mae went down, it was holding.
Okay.
Yeah.
It's the private markets that cause the problem.
It was Wall Street buying. Wall Street did it.
Exactly, you're not gonna face it.
They have something, of course, they have something to do with it. Wall Street is the one that.
They started it.
Well, yeah, let me finish. That's what I'm saying. I mean, Wall Street was one of the principal actors in going and getting some of the rules that were in place. I mean, that they wanted to finance these things that way. They wanted their guarantees. So yeah, I mean,
Well, and of course,
I think that's
well, and it's also where the market discipline is for the Bears and Lehmans of the world to go away.
Yeah.
Not
Countrywide.
and I'd be okay with that.
I mean, I'll give at least the example. This was certainly not the first boom and bust of the subprime market. When the Russia default in the 90s, about a third of that industry went away in the late 90s. The privately state-chartered finance companies did not cause a systemic crisis. Of course, they also required you to have about 30% down if you had a 600 FICO. Maybe that's the one we need to talk about. Let me go to over here.
I have a quick comment on that, and then a question. The losses due to pure credit risk were about $2 trillion. $300 billion were Fannie Mae and Freddie Mac directly, but remember, they never changed the 20% down payment requirements. Their average loan to value was 75%. So the other $1.7 trillion is almost all in the commercial banking system, domestic and international. Banks funded it. Forget Wall Street that securitized it. They made their money and they made their profits. So my question to you is, if your issue is how do we prevent systemic risk, we know the answer to that. State-owned banking systems don't go bust. Now, I would think you would say, oh, yes, but they allocate capital terribly and efficiently. State-owned banking systems are just not a way you want to go. That part is true, but Chairman Bernanke said years after the Lehman bankruptcy that he would have bailed it out if he could, even though we knew by that time that the net worth wasn't minus 1 or 2%. There was only about a 20% return on assets. The hole was more like 80% deep. So the Fed can bail out anybody. And no matter what rules you sit here and talk about, if the market believes that the central bank is going to bail out an institution that's that bad, and it can do it by providing liquidity long enough for it to come back, then those institutions are going to over-leverage and misinvest capital just like a national system would. The only way we get both stability and efficiency is the incentive of equity holders to do both of those things, and that just requires
the question is
a lot more capital.
Whether the solution is capital. You could just nod, yes, no, capital, good, bad.
Well, I think there's a role for community banks, for state-chartered banks, for national banks. It's a healthy thing to have a variety of chartering authorities. And there isn't one model that fits all banks. We need a kind of diversified ecosystem of banks so that when they're bad institutions like Countrywide, they can fail, but not everybody's pursuing that strategy, so it's not a systemic problem.
And I think this is an important caveat to make. I mean, I sometimes feel like when I get in conversations about market discipline, there's an assertion on the other side that if an institution fails, well, then market discipline doesn't work. No, market discipline works by institutions failing. Right. Market institutions do not guarantee that somehow we've perfect foresight and nobody ever fails. That's not the perception.
Profit and loss, and the loss is very important. And even if we do raise the capital standards to whatever level we can agree upon, again, if the Fed's going to step in and bail out the equity holders, which they can do and they have done, then you haven't solved the problem. So
more equity might make a bailout less likely, but doesn't necessarily drive the probability to zero.
Sure.
I just wanted to point out a couple of things real quick. One is that it's hard to make big statements about things like housing and tie them directly into the financial crisis, because we had a lot of different things that were going on there, and we could say that some of those are caused by regulation, others were caused by Fed policy or Fannie and Freddie. And when I at least am talking about systemic risk, I'm thinking about mostly the banking system and how do those underlying problems sort of manifest into a system-wide freeze up in financial intermediation, something like that, right? And so it's not necessarily a problem that Fannie Mae caused or that some kind of housing program caused, right? I'm thinking, why did that problem create systemic risk in the banking sector? And one of the issues, I think, is the question that both Mark and our questioner over here raises, well, the Fed's just going to bail those people out, and the Fed has all this power, and I'm saying that's part of the problem, is that if the Fed didn't have that kind of power, if we made the market participants monitor the banks, then we wouldn't have gotten into that situation where the banks had too little capital or too little liquidity or whatever that caused them to freeze up, right? We need that kind of monitoring, and having the Fed as a backstop eliminates that.
And it's also worth saying that market participants are a way to kind of let pessimistic scenarios. I mean, I think about Enron, WorldCom, Fannie, all of these things are things that short sellers caught before the SEC or the Fed did. So, how do you get those incentives right? Let me go to a question here.
Hi, Carrie Dever, the Center of Copyright Integrity. One of those different questions you were talking about. In 2014, several banks were rejecting credit card payments under $1,000 to Northern Ireland, citing it is still being a location of money laundering and terrorism, yet Northern Ireland's sons come to the capital for St. Patty's Day every year. They cited Dodd-Frank as the source. None of them were able to produce to me where in Dodd-Frank it says you can't make a credit card payment of $1,000 to Northern Ireland. So I didn't know if any of you gentlemen knew where to point me.
I think that's actually Patriot Act more than Dodd-Frank. So
Under 1,000 is not Patriot Act.
Well, not- it's
10,000
not-
or more.
it's
But
not.
they're
well,
the banks are citing Dodd-Frank.
Well, I will certainly say it's 16 titles of hundreds of pages, and I will actually admit to having read at least all of it once. Doesn't mean I remember it. So I don't remember that.
I don't remember that one either, but
And I will
I'd hate to say for sure.
You've got a panel of economists, not lawyers.
Cool. Well,
But I know there's a couple of lawyers in the room.
It's on your radar now.
Thank you.
Thank
That's a
you.
good point.
Yes, Hans Roger RVB. A question to both Professor Hogan and Professor White. But before the question, I wish not to dispel one canard. There was zero provision on the part of European regulators compelling financial institutions to purchase Greek paper. It was something called the reach for yield. All you have to do is to look at the Société Générale, la Banque Nationale de Paris, and Deutsche Bank. And those three are not pushovers. The question in regard to one of the comments which was made by Professor Hogan initially is in regard to how does one conceptualize a pre-FDIC world, taking into account political economy and the departure, as I understand it, of the Diamond-Divik model. So with the assumption also that the first equilibrium of the Nash equilibrium, in fact, of the model holds water, how do you define that without further exacerbating, if you will, the system, taking into account the reactions of the market in 2008 when rumor, noise had much more potent, if you will, importance in the system?
Tom, do you? And I know you've written a little bit on Diamond Divik.
Yeah, so I think so. First of all, you're exactly right. When I'm saying that the regulations encourage banks to buy Greek government debt, I don't mean it specifically said all banks need to hold Greek government debt. What I mean is it gives them an incentive because it classifies that debt as completely safe, so they get regulatory credit. And so if they've got to hold some safe assets, they might as well buy the ones that are high yield, right? And so yeah, that is a little bit more complicated than I was making it out, but clearly you're right that that's what all the banks did. Regarding the question of, well, bank runs, in theory, can be contagious, and if one bank fails, everyone might think, oh my God, all the banks are going to fail, and everyone runs out that day and takes their money and causes all the banks to actually fail. Could happen. However, if we look, at least in the United States, if we look at bank runs, when we had financial crises, even in the Great Depression, we see that the banks that actually did fail were the banks that were insolvent or close to being insolvent, and that banks that were actually solvent tended to not fail as much. And so it seems like even though that's something that's possible in theory, it's not actually what we see in the real world. What we see is that the banks, that the depositors are able to discern through assumptions that are assumed away in the model, but are there in the real world. Banks are able to communicate whether they're solvent or not, and depositors are able to understand that, and they run on the banks that are insolvent, and they don't run on the banks that are solvent.
I mean, you asked how we envision a world without FDIC. Well, we've got lots of historical evidence. We need to study those systems, both in the US before the FDIC, when banks, by the way, held plenty of capital because they needed to convince people to bring them their deposits, and in other countries around the world. And there wasn't a movement for deposit insurance in Canada in the Great Depression because none of the banks failed. And none of the banks failed because it was a healthy, well-diversified system without restrictions on meeting seasonal demands for currency. So if you look at the debate over the FDIC Act, at the time it was quite interesting. The small banks were all in favor of it because they wanted a law that would make them look just as safe to depositors as big banks. The big banks were actually against it. Well, not anymore. Big banks have adjusted to the environment they're in, and sort of one way to summarize U.S. banking history is that we used to make banks weak by restricting them, and now we make banks weak by protecting them.
Yeah, it's worth pointing out on the Canada. I believe Canada didn't set up a deposit insurance system until 1985 or something.
Something like that.
Something like that, and somehow they managed to develop. I mean, I'll note as an aside, they don't have a National Department of Education yet they can read, so I don't understand how that works without these things. That said, also, Carter Glass of Glass-Steagall was against the creation of FDIC. He was in favor of having branch-wide banking. So there are a lot of good examples in that regard. I'll also note one of the important things about the Diamond-Dvibbig model is the sequential nature of it. Before we had deposit insurance, you often just had suspensions. Everybody doesn't get paid, or you remove the incentive for people to want to be first in line by essentially saying that, a bankruptcy-style stay. Everybody will get 50 cents on the dollar until we figure out what the worth is. So there are other avenues to do this that don't cost the taxpayer. And so certainly we have put our thumb heavily on the system to favor one type of safety net, the deposit insurance system, over others. Tom,
Yeah, in fact, when I mentioned earlier, the World Bank looks at deposit insurance around the world. They look at more than 100 countries, and I think they find that around 30 of them have government deposit insurance like we have in the United States. Most of them have some combination of public and private, and I think most of the Western European countries have entirely privatized deposit insurance systems. So even if we like deposit insurance and we think it's a great thing, there's no reason the government has to run it. We find that when we look around the world, countries that have government deposit insurance do worse in terms of having more actual bank failures than countries that have privatized systems.
It's also we're sort of raising, we've picked the direction of the insurance is, on the bank. I mean, your deposit is insured, but it's not like you only get auto insurance by buying car X. And so you could certainly argue for a deposit insurance system where the insurance was with the individual and they could decide whether they want to deal, because even if a bank fails and you get paid, from what I've heard, it's a pain in the butt. So it's not like you want to
And then we might be able to cap the amount of deposit insurance per individual.
I mean, that's certainly worth saying. I'll throw out there, the last time I looked, the median household holdings of insured deposits was about $7,000. And, it's $250 per person. So if you got, wife, 2 kids, that's $1 million in coverage. If you actually have $1 million in insured deposits, I'd like to be your friend. But, it's just not all that common. So again, this is something that's very broad. And span there in a very big way. So I don't know if you guys have anything more to add to that, but I do think there are other alternative mechanisms that get around that. I certainly will note it's one thing that Washington forgets, which any type of insurance, public or private, entails some sort of moral hazard and arguably some sort of adverse selection too. The question to me, ultimately, partly empirical, is will the regulators do a better job at controlling that moral hazard than market participants would have? Are we lining up for questions or just trying to confuse me?
I'm Tim Rogers. I'm a student at George Mason. I'm very familiar with all the arguments y'all are making, and I find them very intellectually satisfying, and they provide a good explanation of the world right now, much better than I'm here on MSNBC or CNBC or any of those. But let's say one of y'all...
I've been on both of those, so I...
No, but let's say one of y'all got the opportunity to go on, I don't know, the Colbert Report or the Daily Show or something. How would you sell this to a more general audience than what you were talking to right now, given the narrative that most people are soaked in about the crisis and where we are today?
Well, I think there needs to be a reminder, and I'll these guys, that these guarantees are fundamentally guarantees for the institutions. And so if you really felt like the retail depositor needed to be protected, then insure the retail depositor directly and do it in a small amount. And so I do think that the public in general has a skepticism toward bank bailouts and what are perceived as subsidies for the banks. So I do think that that's got to be the direct attack. And I also think that most Americans respond favorably to a basic notion of, if you got the upside, you take the downside. when this sort of, heads I win, tails the taxpayer loses, I think most people can relate to that.
It's worse, it's a little bit more difficult, but I think the Federal Reserve has to be part of this discussion too, because if you look back to the 91 FDIC Improvement Act, this is where the securities firms made sure that they could get into the discount window, they could get the emergency lending. Well, I mean, come on, why did they do that? I mean, everybody knows why they did that, right? I mean, that's, and that's a sneaky bailout because it's not a direct transfer of taxpayer funds, right? But it's ultimately backed by the taxpayer. So, in a way, that's sort of their deposit insurance, right? But it gets back to that sort of the government guarantee part to forget about the risk. That's the problem.
I'll note, I don't think I've seen a number of polls throughout the debating and passage of the TARP and since, and I don't think I've seen one where the majority of the public were overwhelmingly in favor of it. So it is one of these things where, and you can ask former Senator Bob Bennett how well that went over. It's one of those things where Washington decided this is what we needed to do, public be damned. And so I don't think the public is overwhelmingly in favor of bailouts.
No.
I don't know how we're doing. Hester, did you have a question? We'll come
Sure,
back to
yeah.
you, Tom.
So you all have talked about moving to a system where we have more market regulation, but we're obviously pretty far down the road towards displacing the markets and replacing it with government regulation. You mentioned a potential solution would be to lower the cap for deposit insurance, but what other solutions do you all have that would be perhaps workable to at least go a little bit back down the road towards market regulation?
And I'll add to that, largely changes kind of within the existing framework. So, we can have a broader discussion some other point about and the Fed and the FDIC and all that, but give me some solutions that, are kind of within the conversation or maybe just outside the conversation in Washington. I'll start with Larry.
Yeah,
Then I'll just come right down there.
If the rationale of deposit insurance is to protect the payment system, then it seems to me you could make the case that we should limit it to checking accounts. Too big to fail, as Mark was saying, I think that's feasible to do away with because it's so unpopular. But if you limit deposit insurance just to checking accounts, which, as Mark said, is less than $10,000 for the vast majority of people, then at least you get uninsured depositors, then people with large savings accounts or corporate accounts, payroll accounts in banks, playing a monitoring role again, as they did back when insured deposits were a smaller share of total deposits. And that at least provides some discipline at the margin. It means a bank that takes more risk is going to pay higher interest rates, are going to have to pay higher interest rates to attract depositors. And that's a healthy market signal.
So lower the cap on deposit insurance. And so you two can't say that. So
Okay.
give me something different.
I go with Federal Reserve and Financial Stability Oversight Council. Congressman Garrett talked about this yesterday. Financial Stability Oversight Council, FSOC. Although there's some interesting acronyms thrown around yesterday, but that's the real one. There was some discussion about the origination of FSOC. Basically, it was supposed to be just a group of regulators getting together and talking, and it became something much different. And now it literally identifies the firms that regulators think are too big to fail. Well, guess who's going to get bailed out when there's another crisis? So that's the first thing that's got to go. And then, again, sort of the broader picture with the Fed, get them out of the business of lending to anybody in an emergency. Anybody. They shouldn't be, they can conduct monetary policy through open market operations. They don't even have to have a discount window. They can flood the market with liquidity if that need be, if that's what you want to do, but they don't have to be directly lending to any institutions. And then I also think, and this is on the edge of the conversation, but I think we need to play around with something even Tom talked about, something like some sort of double liability or some kind of way to just get the equity holders back involved in taking a risk. I had one paper that I talked about, just kind of off the cuff, say, look, we'll let you set up a financial firm free of financial regulations, but also free of any financial safety net if you're a fully liable partnership, something like that.
Like hedge funds.
Yes. And then don't have the Federal Reserve ready to step in and bail them out. But that has to go together.
So to quickly summarize, stop designating people as too big to fail. They're systemically important. greatly restrict 13.3, just provide liquidity provisions, and to maybe give some sort of incentivized opt-out to hold more equity.
Sorry.
Yeah, I was actually
You
going to
can
say,
repeat them now.
well, unlimited liability, I think, is something that sounds really bizarre, but it's not actually that crazy. There are a lot of proposals for things that are called two-tier equity systems or something like that. It's the same thing, right? And people say, the complaint I hear is, well, if we have unlimited liability or double or triple liability, we're never going to have any big banks. And I think that's just empirically false. If we look back in recent history, Goldman Sachs only went private in 2000, maybe 15 years ago. They were a limited partnership before that. They had people that were unlimited in their liability, and they were a major bank. They're top 5 now. They were maybe top 10 at the time. So the idea that we can't have big banks with unlimited liability is just not true. Deposit insurance, like I said before, I think could be reformed. But the other thing is, I mentioned, and you talked about too, risk-based capital regulation that the Federal Reserve uses right now creates systemic risk in the banking system. And when I say that, I get the response that, yeah, but we need it because we need to be able to identify risky banks, and risk-based capital does that better than regular capital ratios. That also is not true. There's now research by the Fed, by the Bank of England, by the World Bank, researchers at NYU and Stanford, and a couple papers that I've written that all find that the risk-based capital ratios are not good predictors of bank risk. And so it's a mystery that we keep moving more and more down the road of Basel. Just this year, we're implementing stronger, more complex risk-based capital regulations. I think we should be going in the other direction.
That would require all the international bank regulators to admit that maybe they got it wrong. I'm going to hold out for that. I really want to thank all our panelists. I think this hopefully leaves everyone with some thoughts for expanding the discussion a little bit more than what we've heard.